Hey, how are you? Dante Royster, Epic Lunch and Learn. Hope everyone had a great weekend. I know I did. The Bears won. So I'm looking forward to seeing that type of output. We are talking live today on LinkedIn, YouTube, and Facebook. Um, let me see if my co host is coming. Hopefully, he is today. We were going to talk about some things. So, welcome to Epic Lunch and Learn once again, the show where real estate meets real talk and your lunch break turns into a masterclass. I'm Dante Royster, mortgage broker, author, and your guide through the maze of mortgages and money. So, we had a great week last week helping out families. That's what we tend to do, try to help out families, obviously, improve their life. We give information such as this. We've had some great episodes thus far, so I want to keep it going. I'm just looking at last couple of weeks we've had some real great guests. So guests, thank you. Nancy King is the first one I wanted to send a shout out to, episode 26. If you get a chance, she really breaks down just property taxes, especially in the Chicagoland area, and just why are they high or low, and just ways to look to modify your taxes, looking to appeal your taxes. So definitely wanted to encourage you to check out episode 26 as well. Let me look at some of these episodes that we had. Had a great conversation with Wendy Lee. Appreciate Wendy Lee joining us. We had April Prayer, episode 23. That was a great episode as well. So definitely, when you have a chance, go to our YouTube channel, Epic Spotlight. Go ahead and click on live, and it'll show you all the live streaming shows that we've done and just the different episodes with different people. But yeah, definitely wanted to send a shout out. And we had a good time last week. We had Matthew Sudica with Nimble Insurance, commercial insurance. That was good information. We also talked about mindset shifts that are very important. So, today I wanted to talk about, we're diving into a topic that is as old as the housing market itself, but it still keeps homeowners up at night. It's called foreclosure. Now, here's the truth bomb. In the first quarter of 2025, nearly 94,000 homes across America got hit with foreclosure filings. 94,000. That's one in every 1,500 homes. Compare that to pre-pandemic levels in 2019, and yes, we're still lower, but the tide is shifting. Quarter over quarter, filings are ticking up. Obviously, there was kind of a lid on foreclosures when you think about it during the pandemic. So that was probably like 2020 to 23, where foreclosures were, kind of stopped. But now that they're up and moving, we are seeing an uptick. So the question isn't just what is a foreclosure, it's why does it really happen? Is it the mortgage products? Obviously, there was a lot of blame that was put onto mortgage people, mortgage brokers, and professionals back in, early 2007, right before the housing bubble. There was a situation where there was a blame on, the mortgage professionals. Hey, you were offering these bad products. But now. Let's dive into that today. Is it bad luck, bad planning, or bad economics? So today we're peeling back the layers, separating myth from reality, and breaking down the true causes behind why people lose their homes, because the more we understand the problem, the better we can prevent it. So I will be joined by Vince Bertocchini in a couple of minutes. He was tending to something. Obviously, we do this every day, Monday through Wednesday this week. Monday through Wednesday, we're going to do it 3 days a week of streaming from 12 p.m. to 1 p.m. Central Standard Time. So if you're in the East Coast, it's at 1 o'clock, 1 to 2. And if you're in the West Coast, it's 10 to 11. But we do this, basically to provide information and answer any questions that you have. So we have a comment section. Feel free to give this, any comments, any questions. So then that way we can help answer these questions and get this information to you. What I found to be interesting was, we were trying as an industry to, really create products that would not put people in financial distress. Overall, you take out a mortgage, that it's a mortgage, you have a payment, and you try to achieve the American dream, or once was the American dream was to own property, own a house, have your own property. So we show you what the payment is every month, and there's an expectation that over a 30-year time frame that you're going to make that payment. You're going to make that payment, and then life happens, right? There's situations that occur. And so I was, kind of doing some research today for this and trying to figure out what are the reasons why people go into foreclosure. What are situations that may I've heard of or I've seen some struggle with. And one cause in particular was job loss. We've seen, anytime you have an income shock, it is an opportunity where that can, derail your best intentions, right? Your intentions are to go ahead and make a payment, every month, but then all of a sudden, if your income it has been, toyed with or changed, then all of a sudden that payment may not be so simple to get to. So when we think of job loss, we can also just think of an income shock. That could be a situation where you buy a house with a husband and wife. We could take a look at that situation. And we have a co-host today.
Hey man, sorry, I was out late watching the Bears victory and everything. No, apologies. I was on a sales call, so it is what it is. Apologies there.
It's all good. Today we're talking about foreclosures and the real reasons why. A lot of times, we wanted to kind of peel back the idea of, is it the mortgage products? Is it not the mortgage products? And if it's not, then what is it? And I feel like, in 2007, we got a lot of blame from mortgage professionals, as a whole, just saying, hey, it was that 228 or that 327. There was a lot of a mindset that we were giving out a lot of arms, right? Fixed for 2 years. You were supposed to improve your situation and then refinance it once your situation got better. And unfortunately, those situations never got better. And therefore, you continue to stay in these arms. And once those payments adjusted, if you were too, low on the totem pole, so to speak, where we couldn't help you anymore, that's when we saw, a lot of major foreclosures starting to occur. And we're starting to see an uptick in foreclosures. It is, I did say, and I referenced, between 20 and 23, there was, basically, hey, no touch on foreclosures, right? For the first,
Right.
during the pandemic. And now we're starting to see an uptick now. It's I read a stat, 94,000 homes across America have been hit with foreclosure filings within the first quarter of 2025.
Did you see what year those mortgages originated?
That's a good question. I did not see that. And it's about one in every 1,500 homes right now. We're seeing a potential foreclosure filing.
I bring that up because the foreclosure, in my opinion, and I'm not looking at any stats or anything.
Sure.
The foreclosures that we're seeing are those that have bought property in 2022 and beyond. For two reasons. They're seeing higher interest rates because rates were higher when they bought their home. Then they're seeing a potential decrease in value, which doesn't allow them to refi when and if rates go down. And also there's an employment picture. Anything prior to 2021 is going to have a very slim likelihood that it's included in those numbers because everybody has equity and in a position that when you're in trouble, you would sell the house before you would go to a foreclosure status.
Yeah, I can see that. I mean, we as an industry tried to, corral and change some of these programs to prevent foreclosure, right? I mean, we did a lot of foreclosure prevention to some degree.
Well, I mean, then again, too, the foreclosure prevention came from a byproduct of we weren't doing mortgages because values were dropping.
Correct.
Right? So everyone came out with a plan. Oh, I'm going to do mortgage modifications, and I'm your expert. I'm your specialty. We had programs for realtors back in those days. You're a short sale expert, this, that, and so forth. It was just a product of the mix of what happened. And to kind of just touch on what you were talking about earlier, The Big Short is truly a true story. If you ever watch that movie as to what happened in the housing market, right? At the end of the day, you had Wall Street met the salesperson, meaning the loan officer, and said, I will give you this product if you can do this. And what I mean by that is your stated, your 𝐒𝐕as, your NINAs, all the products that caused a decline in the marketplace. No one was worried about the risk back then because values just continued to increase.
Yeah, 𝐒𝐕a is stated income verified assets. NINA is no income,
No
non
assets.
yeah, no assets. So, yeah, I mean, it was aggressive, right? I mean, no question, it was aggressive. I just always lean on it's still up to the consumer. Like, you still know what your mortgage payment is, you know what
Sure.
you're getting yourself into. Maybe you should have taken a class. Maybe there should have been a certification. Nowadays, if you want down payment assistance or you're getting any type of grant programs, there's a mandatory, some type of online class you have to take, some certification, where
Mhm.
they're at least trying to say, hey, be wherewithal with what's going on, be knowledgeable of what you're, embarking on. We don't want to see people fail, but people tend to fail. And, I thought today would be a good reason to kind of figure out the whys.
Yeah, I
And
know.
the first one I thought of, go ahead.
No, hit on it because we're going to say the same thing. So go ahead. You were going to say we're going to touch on a little bit of the DPAs.
Yeah, I mean, well, I was just going to go off real reasons. In my opinion, we'll get to mortgage products and DPAs and stuff like that. But I thought the real reason was job loss or income shock, right?
Job loss is the whole reason why we had the '08 recession. It wasn't about housing. Housing turned into be a byproduct of all the jobs being lost because no one had any skin in the game in order to buy the house that you had. So the minute the house went down in value, it was much easier because you had a renter basically in a house because the programs was available. Like you said before in previous episodes, you got a rate because of the conditions of the market. You didn't earn it. And the
Correct.
'08 housing crash was this very similar thing. You were able to buy the house because you didn't have to put anything in. Kind of goes to the same thing to the DPA programs and why they're great, but they have to be done strategically. And we're going to get into a little bit of that. But that's part of the reason why we have our database that we have to put loans into and everything else in the state of Illinois, all because of the things that happened then. So
Yeah, I mean, some of those rules are antiquated in my personal humble opinion and probably need to be removed. But yes, we still in Illinois, only these certain counties across the nation are doing that type of information. Yeah, I thought income shock because of the pandemic, we lost a lot of people. I mean, truth be told, there were some deaths.
yeah,
We were, and because of the deaths, if you bought a house with a husband and wife, and now the wife passed away or the husband passed away, now you're down to one income, and that's not what you signed up for when you said, "Hey, I can make this $2,500 mortgage payment."
correct. But I mean, death has been a factor into that finances of people's lives.
All the time.
Pre-pandemic, after the pandemic, pre-recession,
Sure.
after the recession, right? I mean, it was just a systemic failure basically in our financial system.
And the next stat and another topic would be unexpected expenses and large debts.
Correct.
63, this is from Door Loop, 63.8% reported unexpected expenses as primary trigger to foreclosure. Also large debt, also feature heavy. So I'm thinking of large debts of like, obviously family emergencies, medical bills, high credit cards. There's a little bit of a squeeze, if you're not getting the raises at the job, you're still trying to live a certain type of lifestyle, so costs have risen. That has also kind of like, hey, if I'm used to always making $60,000 and I never got a job, no incentive, no bonus, no overtime, or if overtime's cut,
Right.
these are things that can affect you with the cost of just expenses.
Yeah. I would say medical expenses probably, if you break that down, are a big cost. A medical event is a big cost to that foreclosure number.
Sure. I mean, medical expenses. I mean, just what was it, an article or a book or something like America's getting sicker? Or was
Is
that
it really
Michael?
is it really we're getting sicker, or is it just everyone pays attention to every little thing there is? Like I saw something today, and by all means, this is very, very important. But why are autism rates increasing in the country? And today they're relating something to aspirin and pregnancy as a cause of that, right? Because the numbers increasing? Is it really increasing, or are we just paying more attention to stuff like that?
Autism, I mean, and once again, I'm not a medical doctor and I don't have stats on it. I would say autism has increased. I don't recall seeing that in the 90s or in the 80s as much, but I think it's a very broad term. I would say that because some people may say I'm autistic, right? I mean, if you only focus on one thing, or I don't know. It's just it seems to be more labels being passed around. I definitely would agree to that.
That's what I was getting at, right? Is the number really increased? Is it something to really look at, or are we just labeling things more and more?
Yeah, I definitely feel like we're labeling things more and more. I definitely feel like, but yeah, I don't know. I always thought it was the food. I mean, that's another topic for another day. But when you have three-legged chickens, and all of a sudden they're spewing out, 16 and 24 wings. I don't know. Maybe it's in their food.
When they're all different sizes and everything else, right?
Yeah, I've seen some
or
of those.
let's put it this way: they're all the same size. Something's wrong, right?
Yes. Like, geez, how do they do that? Yeah, so I've always, documentaries and stuff like that. I was food has been a real cause. But yeah, so then the next thing is, I wrote down the cause would be mortgage payments. Mortgage payments have increased, obviously, with the interest rates, right? November 2022 will be forever etched in stone when rates, really doubled. I mean, we were pre-November 22, we were still 3.5, 3.75, and we shot quickly up to 7.25 and got as high as 8%. And I was like, Jesus. Oh my goodness.
What happened here, right? I mean, we're going to need to thaw this out slowly but surely, right? It's going to take a couple months because we're frozen, right?
Man,
it's crazy. You touched on it on Thursday too, right? Property taxes have increased.
Yes.
Homeowners insurance has increased. I mean,
yes.
you kind of brought those numbers to light a little bit on Thursday.
Correct.
In areas that I really don't think of, like when we were just sitting there talking. It is true, right? I mean, I was sitting here talking to a buddy in Florida. I was going to potentially buy a new house, and he's like, I own $1 million property in Florida. He lives in Lutz, the Tampa area.
Mm-hmm.
And he's like, my taxes are around 10 grand. He goes, I'm looking at buying an investment property at $400,000 and the taxes are like 7,000. I go, that's typical here in Chicago, 7 grand, $400,000 property.
Sure.
He ain't getting around it. Right. But that's different in Florida because he's comparing to what he has to what's being built and all the new restrictions and everything else and the cost of doing business. So Definitely. It is more expensive.
It is. And it's hard, and then you're relying on rent, if you have an investment property, and how much can you, get from a tenant? What's the average rent in the area?
Correct. Because eventually it caps out.
Exactly. It's like, hey, in this area only, 1,800, 2,500. And then it's like, well, what am I supposed to do? This mortgage payment is going to be, $3,000 a month. Now I'm sipping into my own personal income that's coming in. And then how do I juggle both? Now, I feel like, this is some of the corrections that were made from the mortgage industry. We required, you couldn't do 100% no money down investment properties. That was a thing back in the day. That was in the day, 2007, you could buy a house as long as you had money for closing costs and you could get it done. It was like, I wish I was there.
80-20 mortgage in February, 80-20 mortgage in August, right? 6 months later, you're buying 2 primary houses, both 6 months in between, no money down on either one, first and second mortgage on both, and you're using a Nina to go along with it, right?
Yeah.
And that's what it was, right?
It was.
Speaking of investment stuff, previous client called me up, remodeled the property out in Round Lake Beach. His family was supposed to move into it. Long story short, they moved to Texas. So now he has a property. He has assets. The house is paid for. And the question came about, Vince, does it make sense for me to turn this into a rental? And we sat here and looked at it. And for the sake of conversation, his name's Chris. House is worth roughly $330,000. The realtor says he can probably get $2,800 to $3,000 a month in rent. Taxes roughly $800 a month. And at the end of the day, he's probably netting $2,100. Then you factor in a management fee because he doesn't want to be bothered with the phone calls.
Right.
about $300 a month. The realtor said about 10% of the rent.
Correct.
So now he's sitting at about $1,800 in positive cash flow income, right? Assuming no major expenses. And I told him, I said, does it make sense to leave $330,000 sitting there for essentially what's 5% a year? And, and don't get me wrong, right? The realtor was on the call. I didn't know the realtor. I was being defensive for the client because to me, I don't think that made sense for him just because he's not going to manage it. He's busy. Has, essentially a monthly income. He rehabs commercial properties. So doing all the excavation work, right?
Sure.
So he's busy. He doesn't need to do any of that. He knows how to do all the repairs and stuff. But that's what it comes down to, right? At the end of the day, you're seeking a couple $100 for what could be the aggravation. And is it truly worth it? He wanted to go through with it. So, I mean, he did it, and even the realtor kind of hit me with like, man, why are you being so hard on this? I said, well, I don't know you. I know him. And we didn't have a previous conversation. I just wanted to make sure he was really seeing what the numbers look like. So that $1,700 was worth it for him.
I love that you went over there, that scenario, because I think we don't as a society have more conversations like that. I mean, there's other things to factor in, right? I mean, obviously there's the tax write-offs,
Sure.
So, hey, now I got a deduction, depending on his, I imagine if he's making that type of money, he might need the deductions. There's also just the appreciation of the property, right? It's 330 now. In another, if he can stretch it out for 5-10 more years, maybe it is, $500,000, you know what I mean? And it's just another savings account for a rainy day. Is it free and clear? I forgot to ask you about that.
It is free and clear, and he rehabbed it for his daughter to live in. So he did more work than what it was worth. And to my reason that was the reason why you don't want to turn it into a rental. Just get rid of it when the market is what it is. You put more money into it because it was your daughter's property and you know how to do all the work. So you over improve the house. You might as well get out of the market, get rid of it, because turning it into a rental, it's going to get abused.
It will get beat up. So, I mean, you have to allocate a certain amount. I would almost, in those scenarios, I don't like free and clear properties on investments. That's always been my kind of cup of tea. I always think you should keep a low balance on those because there's just more money you can do with lumps than you can with the singles.
Yeah.
Right.
Absolutely. I mean, just knowing his financials from doing loans for him before in the past, he has a very high cash flow that comes in through the business. So there's a need for the free and clear property on that end.
Got it. I mean, it wouldn't hurt him to take 60 to 80K, which is tax free, sit it in an account, because the property 100% will get beat up, and it's really just an emergency fund than anything. Of like, what if now you need a new roof, that's 20,000. Oh, you need plumbing is your sub pump goes out and the plumbing from the sewer system to your house is not.
You got to do the whole front line of the house, and there you go, village permits and everything else.
Correct.
And loss of the tenant rent, then you got to find the tenant a place to stay for a month and everything else that goes with it.
Correct. So I'd rather use OPM, other people's money. I'd rather have, a $60,000 to $80,000 balance, nothing crazy. Something that, at the end of the day, using that $1,700 going towards making that payment and just keep it moving. Because to your point, and I think what you were getting to, $1,700 doesn't really move the needle for him. That's not really a lot of money per se. Right. And so it's like, well, then just have it pay the mortgage, because you could do more with $80,000 in your bank account. And, then you could with $1,700 every month. Like, how long will it take you to compile $1,700 to get to $80,000? I'd rather do a cash out refinance. And that's what I promote, and that's what I talk about. I had a client on the call today, this morning, and he's a client that we're working on right now on a home equity line of credit. And, unfortunately, home equity lines of credit are based upon traditional lending, based on your income, your tax returns and such. So, we put it in, and the underwriter got back to us and said, hey, look, house is worth, $400,000. you only owe like 200, but based on your debt to income ratio, we can only get you about, $70,000. And so we could do a line for 70, or excuse me, the line would be for 64,000. And then we have to pay off about $10,000 worth of debt. And then you could get, basically let's just call it 50K, right? So you could have a line of credit for 50K. And he's like, well, he's thinking about OPM. He's thinking about leveraging. He wants to leverage the best he can. And he's like $2,000 away from paying off his investment property. He has an investment property. It was his original house, the storyline. And this is normal for most people. You buy a house, that's your existing home. All of a sudden you get smitten by a young lady. You guys get married. She doesn't want to live in that house because that's your house. That's not the house that you guys, decided on together. So now you're going to take her income and your income, and you're going to go buy the big boy house. So now you have a house together. So you keep that house, and that becomes your rental property. Now they've systematically have gone ahead and basically paid it off. And, so now he's like, okay, what do you want to do? He does want to pay off some debt, he'd rather shift things over where, the customer or the tenant is making the payments. And so I was like, okay, and he was kind of, in flux, because he's like, man, that doesn't really do everything I want to do. I want to pay off this truck. His truck is 64,000. Then he wants to have money for a down payment. And I was like, dude, why don't you just do both? Why don't you take out the line, have him pay off this debt? The line will be the line for you for the investment property. And then let's just cash out the investment property and pay off the car.
Yeah. You know where I'm going to go with this one with him, and just throw it out there. Did you put it out? Did you put it out there to say, hey, let's sell this investment property, clear everything from it, and then go buy a new one?
No.
And you know why I'm bringing that up, right?
The headaches.
Well, not only the headaches, right? He's getting 100% of the money out of the investment property.
Correct.
And he's not leaving anything left into it. And then he's making the decision of what to do with that money, because leaving 20-25% in an investment property, if you truly are a property investor and you really want an investment, is not the right leverage.
Explain that.
So for me, I always look at it, if something is done what it was supposed to do, you're supposed to move on. And he may be able to structure his finances correctly to leverage that investment property to getting what he needs, but he's still leaving 25 to 30% equity in that home. Mm-hmm. So when we talk about other people's money, it may make more sense to just start over, sell that, and buy a new investment property.
I can see that.
Instead of trying to find a second mortgage for a HELOC on an investment, tying it in with your first and everything else.
Yeah, I am, like I said, and these are preferences. And what I love is that there's no right or wrong answers. We're just having a conversation. I always like investment properties to have balances. I'm not a huge fan of the HELOC on the primary. That's not my cup of tea for him. I think he's better off not even touching that, but he's really adamant about having that flexibility. And he's adamant about getting the maximum amount of cash based on his scenario. And so, the investment property is only probably worth about 110,000. We could do a loan for about 75%, make it 82. So he'll probably clear, let's just say 70K cash. And then, he'll have the line. The line will clear him about another 50K. So he'll have about $120,000. Obviously, he'll have all the tax write-offs on both sides. And then he feels like he can kind of maneuver to his satisfactory, to his liking. But it is, or, to your point, there's another scenario, just sell the 110, get the 110. Now you're sold, and then you can buy and hold and maybe put a bigger down payment on something in a better neighborhood that can appreciate more.
Right. I'm not saying don't continue the investment strategy. I'm talking about putting the money to work for you in the best possible way, because you're taking everything you can out of the investment and you're buying a new one at the highest possible point of leverage.
Yeah, it is an interesting topic. And you do have to, I think we're both saying that, people out there, we should consider, we're just in a day and age that I think we all understand we need to be buying assets. Whatever assets you're buying, you need to be buying assets, and the thought and the conversation should be geared towards, how should I buy assets? Now, sometimes, it may not be the most sexy way of doing it, right? It's not a fix and flip, and but it is more normal for someone to buy their first home, and then it is normal that you have that decision of saying, okay, this young lady that I've met wants to get married. She doesn't want to live in this house. And I've seen multiple people in that scenario, right? She doesn't know what other women have been in that house. She doesn't want that,
He doesn't want that ex knocking on the door,
correct,
or whatever could come about, right? I mean,
correct.
we're throwing a little jokes to it, right? But it is the truth, right? I mean, it is the conversation that happens, right? No one wants to move into someone else's mess, right? It's always nicer to just start fresh and start over. And at that point in time, it's always the time to look at it and say, can I keep this other home as an investment? Does it really make sense, right?
Correct.
Because, let's just be honest. I know there's realtors on the call. Selling a home costs money.
Correct.
So if you go and sell one house to buy another house, and you could have created an investment property for yourself, you're saving $10,000 by keeping the home.
Correct.
If it financially makes sense. I'm throwing 10 grand out there between the cost of the selling and the moving and everything out in the short term. So it is a way of accumulating houses. I mean, you don't have to do it all the time, but sometimes people look at it and says, I will never sell a house. I may move, but I will never sell the house. I'll just keep it and rent it. And that's how they build their portfolio of real estate over the years. So everybody has a different take on that. I know we're a little off topic today. Let me kind of circle back. What we were talking about is being prepared for the unexpected, which we've always talked about on these things. I kind of want to touch into the increase in numbers, a little bit of the DPAs, the good and bad, how to use them correctly and different things, because they are out there. There are some downfalls to the down payment assistance programs, and I want to try and get into a little bit of that. I know we kind of outlined a little bit of that today.
Yeah. You know what? Let's do the housekeeping notes now, and then let's get into the DPA segment of it, talking about just mortgage products. Because, I got some ideas of that. So thanks, everyone. This episode today is sponsored by Epic Mortgage. Whether you're buying, investing, or refinancing, call Epic today. That's 708-905-5300. That's 708-905-5300. It's your dreams, your goals. Let's plan together. Now, if you are needing a blueprint, a step-by-step playbook for turning your mortgage into a wealth-building machine, the first step is to go ahead and buy my book, The Ultimate Mortgage Guide. It's on Amazon. The Ultimate Mortgage Guide is a book that can help you whether you're a buyer, seller, or an agent looking to deliver more value than Zillow ever could. This guide changes the game. So buy your copy today. Once this episode is over, I want you to go to our YouTube channel, Epic Spotlight, and I want you to listen to our latest interview with attorney Ernest B. Fenton. He has a rapidly growing firm based in Chicago with a focus on civil litigation and estate planning. A Harvard Law graduate with a background in business management, an educator, author, and entrepreneur, having successfully launched small businesses in both the retail and real estate sector. So make sure you check out the most recent interview with Ernest B. Fenton. And we do have our preferred listings. We have 1413 East End, Chicago Heights. It's a commercial storage. Contact D'Amico Pope, 312-600-7673. We have 6945 South Dorchester Avenue, Unit 2S, Chicago, going for $149. Contact Evelyn Wood, 773-718-9742. We have 2030 East 72nd Place, Unit 3D, going for $109. It's a 2-bed, 1-bath. Contact Evelyn Wood, 773-718-9742. We have 1605 South 16th Avenue, Maywood, Illinois, 4-bed, 1-bath, going for $250. Contact Tamika Bishop, 630-479-6352. And we have 12673 Simbay Court, Jacksonville, Florida, going for a 4-bed, 3-bath. Contact Charday Nix, 904-520-8041. And we have another Charday Nix at 3542 Bella Sarah Lane, Green Cove Springs, Florida. It's a 3-bed, 2-bath, going for $329,990. Contact Charday Nix 904-520-8041. And if we are so lucky, we will have Charday Nix with us tomorrow.
Okay.
And we will be speaking to, what's going on in her neck of the woods down in Jacksonville, Florida. So that'll be pretty neat. So
That's good.
Yeah, no. So let's talk about down payment assistance. I want to get into that because there is a struggle that I have with realtors and mortgage lenders, and are we doing the right thing by the client? So I'll start with this, Vince. Sometimes it feels like realtors at the end of the day want to help someone get into the property with as minimal amount of money as possible, because in their mind, that will solidify the deal.
Absolutely.
And so that's scary, because do we really know what we're getting some of these buyers into when there are other choices that they could choose from that would still, help them reduce how much money they have to bring to closing and put them in a better situation long term without having that second mortgage? You want to talk about that?
Yeah, so I want to touch on that. I want to touch on it first from the realtor side standpoint. Again, everybody's in sales. We're commission based, whether you're a realtor, whether you're a loan officer. It comes into taking the responsibility and the fiduciary responsibility of being a true advisor. It's not the point of pushing someone into a house. And I feel like the DPA programs are that push. They're not ready. They need the DPA in order to do that. And for that reason, they're not ready. They shouldn't be buying a house yet. I touch on the DPA because that second mortgage sits there and it stops you from opportunities of being able to refinance if those options come about, because that second mortgage is there and the values may not be there. It's a protection and it helps people get into homes, but I don't like it because I much rather use an FHA loan with 3.5% down than a DPA program, because in the event that property values drop and rates go down, that person can still refinance without having to do an appraisal or worry about the value. So I'm very pushback on DPAs from the standpoint of using them, because they're mostly CRAs or Community Reinvestment Acts for the banks that provide them to help stimulate housing for an area that's been neglected. And it puts the people that sometimes take that DPA program and puts them in a disadvantage.
Yeah, so some of the DPAs, to your point, require them to only works on certain locations, certain areas, based on the CRA, Community Reinvestment Act. The programs that we have on a broker side, we do offer down payment assistance programs, and it puts us at such a tough situation, because competitively speaking, if we're not offering it, we might lose some realtor relationships, we might lose some client situations. So it is a situation where I've always been kind of back and forth on, like, do I want to use them? Do I need to use them? And so, I tried to tread lightly and use them when it makes the most sense. The one thing that DPAs do offer, which I like, are they remove the MRI on an FHA loan. So all DPAs, for the most part, are down payment assistance are based upon FHA loans, which have a 3.5% requirement. And so if you're buying a $300,000 property, 3.5% is $10,500. So what FHA guideline says is basically, regardless, is you have to be able to show the $10,500. So it doesn't matter if you're going to receive $12,000 in seller credits or anything like that. Or, obviously in Illinois, since our real estate taxes are high, the one benefit you do get is that you get high tax prorations. So with a solid, 4 to 6% seller credit, which is you're able to do on FHA, and with a high tax proration, there could be a day and time where you could say, hey, for this property, all you need is $2,000 to close. And if you were using the DPA, all you have to do is show the $2,000 and you could close the deal. If you were doing a standard FHA deal, you have to show that 10,500 minus earnest money minus tax expirations, you still might have to show more money than you would on DPA, and we would, that could potentially delay the closing. And so that's the only tough situations. But to your point, and I don't like playing God. Are you ready?
Right.
Are you ready to buy this house? Are you mentally? Are you emotionally? Are you monetarily ready to really buy this house? And that's a good question.
And I'm glad you back and touched on it, right? Like if we put someone in a house and at the end of the day, you left the closing and you have $200 left in your bank account, you don't have a 401k, and you don't have other assets, I'm sorry, I feel like we shouldn't have done that loan. And I gave you that opinion and you still decided to go through with it. That's your choice, but you weren't really ready to buy a home. And that's kind of where and don't want to wish that on anyone, but I wonder if those numbers reflect some of those DPAs are those foreclosed properties. Just because
it's something to be considered because
you're just not prepared for the unexpected. What would be the true expenses of being a homeowner?
Well, what happens is we're tied, by contract, we're tied to the performance of the loan for the next 6 months after you close.
Right.
And so to some degree, we care that we're giving you something that you can't afford to make the first 6 months of payments. And then in theory, they are going to continue to monitor that loan and see if there is some type of pattern that's being developed that, hey, every loan that Epic Mortgage does, they seem to go into foreclosure after 6 months to a year. That still could potentially, where we could lose, our FHA capability. So we want to be cognizant as an organization, as well as individual LOs, to make sure that we're doing the right thing. But to your point, as far as strategies, how to exit, I said, well, how do you even know if this person's going to be around, the second lien, right? Oh, it's been 5 years. I pay, they said after 5 years, it wouldn't. Well, do you have the paperwork? How many people have paperwork from 5 years ago? I mean, I've seen some of these, paperwork, 7 years, 5 years, 10 years that you have to maintain the second mortgage. I'm like, is that company even in business to give you a lien release that you're going to need to have?
Doesn't that get recorded with the traditional mortgage?
I'm not sure. I mean, yeah, it obviously does because there is a lien on title. But I'm just saying, like, if that company folds, if that company is sold, the rabbit hole that you're going to have to go down to try to track, hey, I need a lien release.
Correct.
I got a client right now who has a 3-unit property in Chicago, and everything was hunky dory until, there was this second mortgage that shows up on title, and, she didn't even know about it. And it's been 10 years since she even, had a phone call about it because she filed bankruptcy over 10 years ago. So, I mean, this stuff does occur and happen, and it is truly a nightmare in that, it's just one of those situations that the lien release, 5 years from now, but, to a realtor, hey, you did your job. Hey, see, I told you I helped you out. You didn't have to bring any money to the table. See, I got you $25,000 in grant money.
Well, I mean, and that's the thing, right? I mean, we see grant programs fly around with the city of Chicago, Cook County grants and different things. There's nothing wrong with them. It's just one of those things that it should be a bonus. It shouldn't be the reason why you're buying the house. That's all. I mean, I know we're hitting close to the 45-minute marker.
Yeah, let's start doing some questions and stuff. I think and this is Jess. Jess was out there on Thursday, so she's listening to our show today. Thanks for listening. So I think she's saying a good point to the lien release. It's one of those situations where it's hard to get those lien releases. And, Jess is a loan officer. So, I saved my borrower $8,391 by taking away the DPA. And in some degree, I would imagine that's the 3.5%, right? She saved them from having that second mortgage. That's a way you can kind of spin it and say, hey, I saved you that. There's a different way you can go about it. As mortgage brokers, we do have lender credits as well.
Correct.
Where you don't have to pay back. So, we could potentially, with a higher interest rate, which DPAs tend to be higher interest rates, we can get you that same type of lender credit and help you offset, how much money you have to bring to closing.
I use that tool a lot to kind of defer the DPA and just take a little bit of a higher rate. Hey, your lender's going to give you a bigger credit. That'll help offset some of the title fees, and that I do use that a lot.
Yeah, sometimes it just feels like, if you can't beat them, join them. And I've done my share of DPAs, but I always try to find the DPAs that you don't have to pay back. That's the DPA I'm always looking for. There's a new lender. There was one lender only, and then all of a sudden now there's a second lender that has developed this program. So we have lenders that actually give you the 3.5% in a down payment assistance product, but you don't have to pay the money back. Now, I will do that deal all day, every day for you. I just won't do the ones. I'll do it if I have to, but I don't like giving people second mortgages that, now you're going to have to find out, who's my second mortgage with, and I need to pay them off, and how do I get a payoff? Because those phone calls are a nightmare at times. Can realtors do anything legally to help clients stop foreclosure?
I mean, my quick answer to that is no.
No, correct.
Right. But I mean, as far as, helping out with the process or know what's what, I mean, if you're getting into that situation, the only thing, the fastest solution is to call the lender. No one wants to talk about it, but you don't want to talk about the hardship that you're suffering, but that's the fastest way of stopping a foreclosure. Communicate with the lender.
Yeah, I mean, the first order of business is always to try to refinance. I always want to say that before you go down the rabbit hole of loan modifications and all that type of jazz, contact me, right? Let's see if we can do a refinance, restructure things, right? Refinancing is just another term of saying restructure. Let's restructure your loan. Let's kind of start you back over at zero, if it makes sense. Sometimes it doesn't make sense if you got the 3% and now I'm offering, 6.5 or whatever. It may not make sense then unless we're going to pay off some debt or get you some cash out. But see if we can restructure some stuff. I even talked to somebody one time, I say, here, why don't we take this cash out of the property and use that money just to make the mortgage payments?
Right.
Put it in an account. You're going to make the next 2 years and get yourself situated. I don't want you to touch this money other than set up an automatic withdrawal. And I just want you to use this money and take time and breathe and get yourself situated, get yourself through school again, get yourself a new job. But we're just going to take a pause on you using your own funds and use this money, use the equity to your advantage. And sometimes I don't think people really understand the power. That's real dollars and cents, guys,
Absolutely.
In your walls. Take that money out of your walls and sometimes put a pause on everything. Hey, you know what? I'm going to take $30,000 out. This is going to pay the mortgage, and then leave it be.
We've said this, right? If you're in foreclosure, it's too late for us to do a refi.
Correct.
Unless you have a tremendous amount of equity in the property, which goes to the point of you shouldn't be in foreclosure. But what was it? The shift lady that we had on?
The shift lady. Yep.
So, I mean, case in point, right? If you know something's coming wrong or things aren't working out, you need to do the shift. And sometimes taking a line of credit to cover the bills for 6 months or a year may be the right alternative.
Correct. All right, we got another one here from Antoine. Can credit counseling really save a homeowner from foreclosure? I think this is no, but I think it's preventive.
Educate.
Correct.
Educate, but again, that's not saving the home, right? No. We need to save the home.
I mean, basically, you are signing a mortgage document that says this is X going to be your payment per month. Whether it's $2,000, $2,500, $3,000, you're agreeing to make that payment, 360 times, which is 30 years. So
let's back that up. Let's do a year at a time first before we're talking all 30 years, okay? Because if you get in trouble and you make your payment on time after you got in trouble for a year, then we may be able to help you.
True. Yeah, normally lenders want to see no more than 1 times 30 in the last 12 months. I think it's safe to say. I know there's some provisions with FHA, with 3 months or VA per se. So there are some nuances that can help. But my point is that you've agreed to make a mortgage payment. And for whatever reason, whether it's job loss, a loss of income within the household, an unexpected expense, insurance changes, taxes changes. Something has happened that's created an issue where you no longer can make that payment, on time, and you're late. We got to get that figured out as quickly as we can.
Correct. Want to touch on one thing before you hit the next question?
Yep.
If you truly are at risk of losing the house, and for whatever those reasons are, and you qualify for it, a bankruptcy stops the foreclosure from moving forward. Again, that is a whole other option, but it does stop the property from being foreclosed on. Whether that's a 7 or a 13, it gives you a protection for a little bit of time. Let's hit the next question unless you want to add something.
No, that's good. What's the biggest myth about low down payment loans?
You want me to go first?
Yeah, you go first.
To me, it's a low down payment, but they're making the money back somewhere. Whether that's a higher interest rate, somewhere down the line, somewhere along the line, something is getting paid back. And if it's a payable,
correct,
second or low down payment option, it's tied something in. And what I mean by the tie-in is banks offer DPAs to meet their CRA requirements. So there's always an end result to it.
Yeah. I'm with that. I think the second lien, right? If I was talking to Chris, I'd be like, just be cognizant that it's a second lien. So I think sometimes there's a play where people don't know where the money's coming from. They know they're getting some type of money, but I don't think they truly understand that, like, it's this second lien that's going to show up on title, and it's got provisions to it, right? If you refinance or if you sell the property in the first 5 years, you got to pay it back. Well, right now in a low interest rate environment that we're headed towards, that's counterintuitive.
Well, there's that piece to it, and then what if the value is not there? Now you got to come back and pay that money back in order to take advantage of the lower rate, right? I don't anticipate values coming down. We've said that over and over and over again. They may come down very little, but when rates drop, the value should hold. So it's kind of a balancing act. I don't trying to get into that. Like I said, I personally stay away from this type of product. It's just my personal business preference.
Yeah. We do what we can for our clients, but we are mindful of it. Let's see here.
What's our number look like today? How many audience?
Right now, we got 290 people listening to us, so that's pretty cool. So we appreciate you for listening. Make sure you give us a like and share with friends and family that want to hear this. Like I said, the recording of this live stream will be on our YouTube channel. Epic Spotlight. You just click on the live and you can see all our episodes that we've recently have done. I've had some great conversations with the shift lady. I forgot her name, so I was like, yeah, we had a great conversation. And then also we had Nancy King on. We had Matthew Sudicka last week. So we've had some great guests. And tomorrow we got Sharday Nix, licensed realtor down in Jacksonville, Florida. Hector Arroyo with Allstate Insurance from San Antonio, Texas. He might be joining us too. So we're gonna try to bring as many people on. Maybe we will get this Jess Ford on here with us, a licensed loan officer.
You know what? Speaking of that, we put that out there to the audience about a week ago. Anybody wants to join us, all you gotta do is let us know. You're welcome to join us. I know I want to touch on the Spotlight episode. I already kind of watched it. So everybody just remember, someday we'll talk about all the pivots that guy talked to you about in that broadcast.
Oh, you heard that?
Yeah, I did.
Yeah, he was Ernest B. Fenton, Epic Spotlight podcast. The pivoting that he has done and just strategic has been quite something.
And it kind of relates to what we talked about here today too, where some of his pivots were.
Correct.
Just in business and in life. I mean, just
when you said it,
we didn't plan it that way, but if you watch it now and you kind of read it back with the question we had on Thursday and the episode when I watched it, this is kind of why I prompt you to kind of do this show today on this outline when you hit me up. Like, what are we going to talk about on Monday?
Yeah, I knew it was going to be you and me, so I was like, here, let's make sure. But no, it hit home. Obviously, I think it started with Jess.
It did.
Just putting her comments in.
Yeah.
Really appreciate that on Thursday. That kind of sparked that whole idea, and then it kind of was perfect timing with Epic Spotlight podcast interview. Ernest B. Fenton, the attorney, he really talks about how he pivoted his business based on things that he saw in the marketplace that was a need, right? I mean, obviously in business as entrepreneurs, we all are here to solve problems. And so you have to kind of determine what problems do you want to solve. And then if you can do it at scale, you will be very successful. And so, figuring out people's needs and wants and solving that problem. What do you have in your arsenal? What do you have in your toolbox to solve these problems? And that's really what Ernest did. He saw an opportunity in the marketplace. He solved the problem. Then he pivoted to another issue. And then he's been doing that for years on years. And that's where he's really established his business. So very thankful that he spent the time with me and had that call. Let's see. Shout out from Clayton. Appreciate that. This has been eye-opening for realtors and investors alike. Appreciate that. If we can help you out in any way, we'll wrap up with this one, and then we could talk about some things. Are most foreclosures really tied to job loss more than bad loans?
I would say yes. The job loss is more than the bad loans. In today's market, it's very difficult to say you did a bad loan. There's a lot of due diligence that are done. If you use a bank statement program, you're more than likely putting 20% down into a home. If you use traditional lending, whether that's FHA, VA, or conventional, it's full doc, meaning W-2s, tax returns. So what was the skin in the game or the verification process is now there to eliminate what would have been perceived as bad loans. And it's more of a life event that happened, which would be a job loss.
That's awesome. Yeah, well said. Yeah, I mean, we're not really doing ARMs. The adjustable rate market is slim to none. It's pretty much standard now. So yeah, I think 100% is bad loans is kind of a myth. It's not accurate. I think what's accurate is personal situations, to what you said. It's interesting. I did get some stats I wanted to share. Because based on just foreclosures.
Caleb Williams threw for 4 touchdowns, no picks. Right?
Oh, come on, man! It was.
We're talking about those kind of stats now. Let's see what happens next week. Let's get to the right stats.
Yeah, I mean, obviously, consistency, right? In any business that we do, we want to be consistent. So now you showed the world what he's capable of. Against a bad defense.
There you go. At least you said it. It's against a bad defense.
A bad defense. And that's typical Bears fans. We'll never be happy. Like, we'll always find we can't just be happy with it. Now we got to nitpick it. Like, oh, okay, well, he did 4 touchdowns, no turnovers, but it was with a bad defense. So let's see if he can do it with some. So I don't
still
think
under 500. There's that stat.
Yeah, and I love how the coach spoke. Right after the game, he spoke like, "Hey, we still have dug ourselves a hole. We got to dig out." Hey, it's great that we got one under our belt, but we got to get going. I was really surprised with the outcome of the Raiders Washington game, and so I was really surprised. I had Vegas in that game. So so now it's like, well, you got to beat them.
Hey, well, Green Bay lost yesterday, so to the Browns, so that helps.
Hey, it was a great. Hey, I always look at it in quadrants. If you look at the football season, it's in 4 quadrants. I said 2-2 coming out of this. I thought we were going to beat Minnesota, and we should have. I thought we were going to beat the Raiders. So if we can beat the Raiders and finish 2-2, I'm okay with where we are. So it's very important for this week. But here, I do have some stats. So it said in Illinois, foreclosures right now are 1 in 857 homes. In Indiana, it's 1 in 976. And to Jess's point, in Michigan, it's 1 per 759 housing units. So there's definitely, 1 in every 759 homes facing a foreclosure filing isn't catastrophic by itself, but trending upward for sure. And it's worth paying attention to. So it's an early warning sign when we're looking at Michigan. But Michigan is not that, it's not among the worst.
I was going to say, anything on that chart for Arizona, Texas, or Florida?
No.
Okay.
Nevada won in 87.4. South Carolina, Michigan is not among the worst states in absolute rate. Puts it around U.S. average. It's just average. But yeah, I mean, obviously, I think overall there's definitely an uptick in foreclosures. I think that's because we're coming out of the pandemic, and so now this is what we're getting back to business, right? Getting back to normal things.
Sure.
And I think it is life events that do create most of the chaos that we have to be mindful of, and I think you just have to do the due diligence. I mean, we talked about scenarios where people are deciding what to do with a second home today, right? Should I have it as an investment? Should I sell it? Oh, should I rent it? These are things that people are making decisions on based on their income. They're making enough money where it's not automatically, oh, let me get rid of this home. There's like, hey, I got 2 properties now. What should I do with it?
Right.
And one of the things about the book and the mentality is turn this mortgage into a wealth money making machine. You can turn this house into an ATM, whether you want to get a lump sum of refinance cash out or systematically every month as the rent comes in. These are great decisions and great problems to have.
Yeah, I mean, and then too, right? You've been doing this for how many years?
Oh, June 24th, 2002 was my first day in the business.
So if you really take that stuff, right, we're talking 23 years. And if you take that information, you take the education, you're now starting to see that end product of someone who maybe held onto that loan that amount of time, who's actually seeing those profits, or that opportunity of a property cash flowing because it was paid off, because they had a tenant in there for so long. Like another thing for me, I have previous clients calling me that their kids are ready to buy a house. I don't think of it that way, right? But from a marketing standpoint, I should be reaching out to my old clients and asking, hey, is Tim or Samantha ready to buy a house yet, right? Because, hey, how do we get them into that house? How do we create those things? So, again, it's all about preparation. Today was really about the questions we had on Thursday kind of prompted my mind to bring this back up, because one of the last questions there was that are DPAs predatory, right? And we kind of touched on some of that. And then when I watched the Epic Spotlight over the weekend, this kind of popped into my head when we had that conversation. So I know we're over our hour. I'm Vince. Thanks for listening, everybody. I'll turn this back over to Dante, and I'll see everyone tomorrow.
Yeah, basically, I put this in the chat right here. It's www.danteroyster.com. This is where you can sign on to our newsletter. So you go to the website, and right on the front page, you can sign up for the newsletter. We can get you there. Our newsletter comes out every Friday, and we're just getting organized with the show. Epic Lunch and Learn is here to stay. We enjoy it. I learn something, and I'm meeting people, and that's always a positive thing. And we're really going to be predicated to Monday through Wednesday. So this week we're Monday through Wednesday. We do have jobs as far as helping closing deals. So wanted to, say thank you to the families I was able to help, the Coleman family, the D family, the G family, no relation, D and G, hilarious. In the same week, nonetheless, the Smith family and the Nelson family. So we were able to help out those families buy new homes last week. So wanted to give a big thank you to that. And that allows us to, spend the time talking with you, and hopefully you're ready to take that plunge, whether it's buying an investment property or a primary residence or refinancing, obviously, taking advantage of the market. Let's look to have these strategic things. I love what you said, Vince. It is all about being proactive. And we're just in an era now where we have to stay proactive in what we do each and every day. And so that's what we're here to do. But we'll be back tomorrow. Hopefully we'll see who's here, but Sharday Nix, Hector Arroyo, they should be up here, and hopefully Vince, you'll be here, and we'll have a good foursome.
Yeah, you'll see me on time tomorrow. No lateness. I'll be in the studio waiting room. I had a phone call take a little longer than I thought. So
yeah, no worries. All right, man. Have a great one, and
you too, man. Thanks everyone for listening. Have a great day.
Take care.